Good evening, and welcome to the Future of Finance here at Melbourne Connect tonight. Before we begin this evening, I'd like to acknowledge the traditional owners of the unceded land on which we work, learn and live, the Wurundjeri and the Woiwurrung people. We pay respect to elders past, present and future and acknowledge the importance of Indigenous knowledges. My name is Imogen Crump. I'm the editor of Pursuit here at the University of Melbourne and I'm very happy to be here this evening for this event. Although those of you joining us online may not be experiencing it, tonight's wild Melbourne weather feels rather apt as we explore the stability of international financial systems. While finance operates as a largely self-regulating and stable system, the complexity of today's global financial landscape certainly does not make it immune to shocks. So how do we navigate the future of finance in an age of constant disruption? In today's digital, interconnected world, economic disruption travels at the speed of light. Market crashes spread globally in minutes, policy announcements reshape entire sectors, and new technologies bypass traditional gatekeepers. Meanwhile, broader forces like climate change, artificial intelligence, and the gig economy are rewriting the rules of how we create, store, and transfer wealth. So tonight, the Future of Finance will explore these growing vulnerabilities and provide informed cross-sector dialogue to help us achieve a more resilient and inclusive financial future. Conversations like these are at the core of what the University of Melbourne does that extends well beyond our campus, from nurturing tomorrow's leaders to conducting Nobel Prize-winning research and ensuring crucially that that research translates into real-world solutions. Melbourne Connect is the final piece of the puzzle, transforming academic insight into actionable solutions. Tonight, the Melbourne Connect team have assembled a really fascinating group of experts and innovators for this, what I hope to be a fascinating conversation. I look forward to hearing their insights and learning from their expertise as we navigate some challenging questions together. To begin with, I'm delighted to invite Chancellor Jane Hanson, AO, to welcome you all officially on behalf of the University of Melbourne. Thank you, Jane.
Thank you. Thank you, Imogen. And good evening, everyone. It is my pleasure on behalf of the University to welcome everyone to our campus tonight and to thank you all for participating in this public discussion on the future of our financial system. A pressing topic as we reach several inflection points in an increasingly interconnected and digitised world. I also convey the apologies of our Vice-Chancellor, Professor Emma Johnson, who is unable to be here this evening, although she had very much hoped to participate in the discussion. We meet tonight in one of our newer buildings, located on the former Royal Women's Hospital site. Now in its fourth year, Melbourne Connect is our dynamic innovation precinct, designed to foster collaboration between research, industry and government. It is a vibrant hub for advancement in AI, medtech, sustainable technology and design innovation, and an ideal place to host this kind of forward-looking conversation. This event forms part of Melbourne Connect's The Future of showcase series, held 3 times a year, designed to bring together experts from academia, industry and government to explore complex societal challenges and imagine what the future might look like from a particular vantage point. Tonight's discussion, The Future of Finance, will explore the growing vulnerabilities of our global financial system. In a world where market shocks ripple across borders in minutes, where tariffs can disrupt entire economies, and where synthetic and speculative digital assets operate outside traditional oversight, the need for informed, cross-sector dialogue is more urgent than ever. Yet public debate on these issues is often polarised, self-interested, or increasingly overwrought and alarmist. That is why we have assembled a distinguished group of academics, industry experts and regulators to examine these questions intelligently and to spark important, informed conversations about how we maintain a resilient and high-functioning financial system. Of course, convening respectful public discourse based on reason, evidence-based discussion and debate is only one part of the university's role. Our core academic mission remains to provide an outstanding education for our students and to foster world-leading research across many disciplines. I'm proud to say that the latest rankings, the Times Higher Ed rankings, we continue to be ranked #1 university in Australia and among the top 40 universities in the world, based on a comprehensive set of measures of teaching and research excellence. One of our largest and most important faculties in reaching these sort of rankings is the Faculty of Business and Economics, which delivers our foundational business degrees and is well represented here tonight. The university has a proud history in this discipline. In fact, this year we have been celebrating its centenary, marking 100 years of contributions both in economic theory and applied policy. On tonight's topic, I also note that economic history continues to be taught in the program. This remains important in the hope that we may learn from our accumulated knowledge of the past to better inform the present. As the Nobel Prize Committee reminded us recently in awarding the Nobel in Economics for 2025 to the eminent economic historian, Joel Mokyr, sustainable economic growth cannot be understood without connecting the disciplines of history, economics, technology, and culture. This brings me to my last point. Looking back over my own long career in finance in London, New York, and Australia, I have witnessed more than a few boom and bust cycles. Most memorable were the introduction of the subprime and mezzanine financing that fueled the M&A booms of the 1980s, and of course the related GFC of 2007 and 8, which felt like the closest we had come to an implosion of the entire system. But in every case, I have marvelled at the self-regulating nature of the system. Two observations I would make in this continuing evolution: that there is always a generation of brilliant young minds, entrepreneurs, risk-takers, change-makers, keen to experiment and innovate, some of whom, in pushing legal and regulatory boundaries, will sail too close to the sun. And second, at some point in the cycle, various players in the industry, along with government, will work together to ensure that the global financial system survives, albeit with more regulation, and resilient enough to endure the next wave of innovation that tests its limits once again. So I very much look forward to hearing from our speakers this evening as they dissect the developments and the disruptions that are reshaping, and some might say threatening, the future of our financial system today. Once more, my warmest welcome to everyone attending tonight. Thank you.
Thank you, Chancellor. Please welcome Professor Edward Hovey, Executive Director of Melbourne Connect, not Melbourne Direct. Thank you.
Good evening, everybody. Welcome to Melbourne Connect. It's really nice to see you all here. It's a great audience. We had about 600 registrations. That means about over 300 people, 350 people. It's wonderful to see this turnout despite the weather. So Melbourne Connect, just for those of you who've been here for the first time, is a precinct purposely built by the university to deliver the university's products to society and to government and to industry. And these products are not only students, they're also faculty members, they're ideas, they're prototypes, they're patents, they're all kinds of interesting things that universities develop that should transition into society to make life better for us all. And that's what our purpose is here today. One of the things we transition is ideas, and this series, the series The Future Of, is one of our flagship event series. We hold this one, as Jane said, 3 times a year on different topics. The previous one was on longevity, the one before was on disinformation. And the idea is to invite people that you'll see tonight, experts, to come and tell us in lay terms, not expert terms, but with an informed background, what's going on, what can we expect over the next 30 years in things that touch our own lives. And heaven knows, the financial system, the security of our money touches everyone, the lives of each and every one of us. This is an important topic. A friend of mine who was in graduate school with me and worked in the World Bank in New York all his life, he told me, we've had a period in the West of almost 70 years of unprecedented freedom and stability. And during this time, the financial market, the financial system has optimized itself through technology, through developments, through regulation into a highly tuned, highly specialized, highly efficient system of managing money and managing our affairs together, right? But it's highly interconnected. It's like a Ferrari on a highway. It's fantastic. But when the highway has a pothole and when the highway has a speed bump, then you don't necessarily want a Ferrari, you want something more like a Land Rover. The question is, given, as Jane and as we've heard already, as Imogen mentioned, we have tariffs being imposed by some presidents of some countries. We have all kinds of things, like long-term things, like COVID happening and disrupting the economy. We have threats like the AI revolution, which may completely disrupt what's going to happen to our workforce. We have the environmental crisis, which may come, long-term systemic things, short-term sharp shocks, a little subprime mortgage crisis or something similar, the personal loan crisis in the States, may impact the stock market and may in 6 hours do a lot of trouble, make a lot of difficulty for your own stocks here in Australia. What are we doing about that? How is that being protected? What do you say to somebody who's young and saving for a mortgage, or someone like me who has a lot of superannuation and wants to make sure that my superannuation will be there when I need it? What do you say to those people? What are the guarantees for stability? We invited 4 kinds of people to speak to you tonight. The first one is bankers. And so we have Alan Oster, the chief economist of NAB, retired, and we have Simon Dobson, who is at ANZ, and they will tell us what the bankers are doing to guarantee the stability and the safety of our money. They are the stewards of our immediate money. We have Simon O'Connor, who will tell us about investment and the sort of longer-term patterns of investment, and should you invest sustainably or not, and how does that work? Simon is here at the university. He's just started a new hub, a new research center. We have people who look at the technology side, the people who are inventing the technology, the internet that brings everything together at the speed of light, as you heard, or the people who invent cryptocurrencies that the rich and the criminal are using to circumvent taxes and oversight and stuff like this. What is happening in the technological world, and what are people in the technology side doing to actually make things better and to protect us? We have Nadia Massoud from the business school here, and we have Talis Putnans from the University of Technology, Sydney, who heads an ARC center that looks exactly at this kind of issue. We have, of course, the regulators, the government-appointed people who actually look at things and make sure that things are done properly. So we have Alan Fels, who retired the chair of the ACCC. We're very grateful to have him. He's also here as a member of our law school, the University of Melbourne's law school. Thank you, Alan. And then we have, and not to be forgotten, above all, I think we have Ian Harper, the retired dean of the business school, who has a picture wide over everything, in all different kinds of aspects. And I'm very grateful, thank you, Ian, for taking over. We had initially the Assistant Treasurer, the Honourable Dan Molino, who was going to be our keynote speaker, and last week they told me, his staff told me, he just cannot come. He has to stand in for the Prime Minister somewhere. And so Ian was very gracious in stepping into his role and taking up the time and describing to us the real roots of the problem and where we are and what's going to happen. So tonight what you're going to hear is the keynote will explain the problem. As I said, Ian will do this. Then you'll hear the 6 speakers, each one of them in 6 minutes, just telling you who they are, what do they represent, what do they know, what do they think. We have then a short break, and after that we have 2 panels. One panel is technology and banking and how that's transforming itself, and the final panel is what's the stability in terms of short-term shocks and long-term systemic changes. I hope that you find the evening interesting. I know from talking to all the speakers, it's going to be a fascinating evening. Welcome, thank you.
Thank you, Professor Hovey. The rich and the criminal is my takeaway from that. I'm now very pleased to welcome Professor Paul Kaufman, Dean of the Faculty of Business and Economics at the University of Melbourne, our hosting faculty for tonight's event.
Thanks, Imogen. Welcome to the Future of Finance. It's an event co-hosted by Melbourne Connect, the Faculty of Business and Economics, and Melbourne Business School. Tonight, we will hear from Australia's brains trust of finance. While their focus will be on Australia's financial system, the ramifications of their views and observations resonate globally. Take the diminishing role of trust in finance. A cliché, perhaps, but we are at a crossroads with a tried and tested financial system built on traditional principles of trust, so characteristic of banking cooperatives, neighborhood branches, and tellers. Fast forward, and tradition is pitched against the volatile financial ecosystem, invaded by fintechs, ruled by blockchain methodology, and overseen by sandbox regulation. The traditional notion of finance built on trust has long since gone. Some 4 decades since deregulating the financial system, the battle for market share has fundamentally changed the trust relationship between financial institutions and their clients. Innovative, complex financial products are now in reach of retail clients, supported by marketing campaigns and social media. While that has increased competition and consumer choice, it has also opened Pandora's box of conflicts of interest and information asymmetry, eroding public trust in the financial system. Of course, trust crises are nothing new. Think market crashes, insider trading, rogue traders, but they were mostly short-lived, quickly fading from our collective memories. More worrying is today's observation of structural, persistent distrust, calling out for regulation. Unfortunately, our regulatory and legislative safeguards are not equipped to replace the role of trust. Inadequate funding, for example, makes it difficult for regulators to compete for talent, just when that talent is most needed to manage the complexity and pace of today's financial system. Add to that a legal system which is increasingly expensive, time-consuming, and lacking expertise in neo-finance. Arresting and restoring trust seems a much more effective option. But to do that successfully, we need to define, measure, and manage trust. Is AI the solution or a further trust erosion? Evidence suggests that AI and trust are positively correlated, but it is a very noisy correlation. I'm looking forward to hear from our panelists to shed light on the challenges in the future of finance. Thank you.
Thank you, Professor Kaufman. We now turn to our keynote address. I'm delighted to introduce Professor Ian Harper, Emeritus Dean of the Melbourne Business School. Please join me. Thank you.
Well, thanks, Imogen, and good evening, everyone. Like Professor Hovey, whom I thank for the opportunity to stand in for Minister Molino, I'm also surprised that so many of you have come out tonight, given all the weather warnings that have been broadcast all day, so thank you for coming tonight. But there's a little message, I think, from the Faculty of Business and Economics, our host for this evening, to our colleagues and friends in the Faculty of Engineering and IT. Never underestimate the power of money to draw a crowd, right? Whatever the weather might be doing. Well, speaking of money, friends, I have the privilege to serve on the Reserve Bank of Australia's Monetary Policy Board, and therefore it's incumbent upon me to make this claim now, and that is that this evening I'm not speaking in any official capacity, so I'm not speaking on behalf of the Reserve Bank. For better or worse, you're going to get the benefit of my own personal opinions. Now, I was asked, as you heard Ed say, to step into Minister Molino's shoes and give you a framework for thinking about the types of remarks and comments you're likely to hear from the other speakers this evening, including myself when I join the panel on regulation a little bit later on. We're here to talk about the future of finance. But one of the things that you learn if you study finance in any depth at all is that you can learn a lot about the future of finance by studying the history of finance. The reason for that is that many of the episodes that we experience are repeated through history. They tend to take a different form as the technology changes, and it tends to be a different set of regulations which are sidestepped or challenged, as the Chancellor pointed out earlier on. But the basic idea that there is, if you like, a dance between the financial markets and the financial institutions and the financial regulators, and that waxes and wanes over time, that's perennial. And so one of the things that you'll be hearing this evening is that worked out again for the future that we face right now. So listen out for people making claims about the future where you can recognize one of three themes from the past that I'm about to outline to you now. The first is this one. There's a long-standing tradition in financial markets and financial systems of tension between what we call financial innovation, so new ideas, new products, new processes, and financial regulation. There's a tension, as I say, because the innovation, with lots of positive things to say about it, often runs up against the boundaries of what we regard as being in the best interests of society. And therefore, society seeks to regulate or impede a process of innovation that in other respects people might regard as not just harmless, but actually beneficial. The fact is that innovation is, in many respects, beneficial. But there are also public interests and social interests to be considered alongside the private interests that are served by innovation. So listen out for that tension and how it is managed. It has a long history. Kings and other sovereigns in the past decided that minting coins, gold coins, and impressing upon the face of those coins their own images was a great way to standardize the use of currency, gold specie. It didn't take long for the markets to work out that you could clip those coins or shave them. So they looked like they were the real thing, but in actual fact, of course, they were short-weighted. Then it didn't take long for the kings and other governments to decide to impose penalties on people who were caught doing that. And some of those penalties were quite severe. And then there were technological changes that caught up with it, like the inclusion of rimmed edges on coins. Difficult to show that to people these days. But the rimmed edges on coins were designed specifically to make clipping or shaving more obvious to the person who was being offered the coin. You might think these are ancient historical examples. You would have seen in the press just this week warnings again about people being handed fake Australian dollar bills, counterfeit bills. You might have thought that was something in the past. No, it's still with us. And people are being warned again to watch out for things like that. The penalties for handing off, for passing off official documents, official notes that are in fact counterfeits are quite severe. And the battle works backwards and forwards. In place of rimmed edges, we now have the various designs which have been imposed, very sophisticated designs on currency notes, and that's just physical currency notes that we're talking about here. Originally, when people deposited gold with the forerunners of modern banks that operated on a bench, which is where the word bank comes from, banco in Italian, those gold deposits were honoured with a receipt from the banker who would say, well, here's the deposit, I'm keeping your gold for you. It didn't take people long to work out that you could negotiate those notes. That is to say, you could hand them from one person to another and say, look, I've got gold sitting here with this banker, accept this receipt in exchange and I'll sign it. Then it also didn't take the bankers long to work out that not everybody turned up at the banco to claim their gold back. And so in the meantime, rather than it just sitting in a vault gathering dust, you could actually lend this out on the basis that not everyone would turn up at once. And fractional reserve banking was born. And then it didn't take people long to work out that if they did all turn up at once, the gold wasn't there. And bank runs were born. Oh, again, ancient history, you say. Ancient history? Bank runs in this state in 1990, the death of the State Bank of Victoria, the destruction of the Silicon Valley Bank just in the last couple of years. Same thing, same phenomenon, different names, different faces, the same thing. When you all turn up at once, what you thought you were promised turns out to be a fake. There's a regulatory dialectic, as my professional colleagues describe it. A simpler word is just a dance between the regulators and the innovators. Not all of the innovation is bad, but it needs to be regulated to ensure the public interest aligns with the private interest. That's theme one. The second theme for you to listen out for in the remarks that my co-panelists will make tonight is this one: efficiency balanced against stability. And there'll be plenty of people who will tell you that there are much more efficient ways for us to arrange payments, to arrange wealth management, borrowing and lending. All of these functions could be handled much more efficiently if we used, for example, blockchain technology. There's nothing wrong with blockchain technology. Will it result in greater efficiency in certain contexts? Well, yes. You need to be careful, though, in thinking about what you mean by efficiency, which costs are saved, which benefits are served. But in principle, a technological change like that can substantially reduce cost. One thinks immediately of making international payments. Those of you who are in this audience and online would know only too well, if you're involved in making international payments, how expensive and convoluted that system can be. Surely there's a more efficient way. Well, arguably there is. But you also need to be very wary about these same changes that will introduce or improve efficiency and the impact that they can have on system-wide stability. It's often the case that people who are advancing a case for efficiency, for competition, for improvements, reductions in cost, don't think about the system-wide stability implications of that. A lot of these improvements are desirable. Older members of this audience, not younger members, would remember when even you travelled interstate in order to be able to access your bank account interstate, you needed to have what was called a black light account. You had to have a passbook where your signature could be seen under ultraviolet light, and only then would a branch of your bank honour your request to withdraw money. It sounds like antediluvian technology. Probably was. We don't even think about that problem now. A lot of efficiency improving innovations are just that. But they can also produce instability. Take, for example, stable coins. There's another potentially efficiency enhancing mechanism, not new. Banks were issuing private coins and private notes in the 19th century. That is not new. Well, why did it come to an end? It came to an end because of the bank runs which it gave rise to. And central banking was born, and privately issued notes, the 19th century equivalent of stable coins, were basically outlawed. And now the market has reinvented them. And we've seen once more the same problem that arose originally. We've had the failure of Terra USD, and perhaps others will follow. Why is that? Because at the end of the day, if there aren't enough assets to back this up, when everybody decides to cash in their stable coins at once, you have the re-emergence of an instability problem that is as old as the hills. Not necessarily a bad idea, but one that needs to be managed carefully. Think about efficiency versus stability. Don't always be sold on the efficiency-enhancing aspects of these innovations without thinking about their system-wide implications. And the third and final theme I want you to be listening out for in this evening's conversation is centralization versus decentralization. Again, decentralized finance is not new. There is extensive evidence of the history of currency use, from shells, metals, even claims on corn stored in ziggurats, right? All of this decentralized mechanisms for facilitating exchanges of goods and services are very, very old. One thing that is genuinely new, though, is the distributed ledger technology, the technology which underlies the blockchain. That is genuinely new. That's a digital invention. And that may well enhance the capacity for decentralization to work in finance where otherwise it might not. While decentralization has a long history, so does centralization. And centralization itself, again, is not new. We've already spoken about sovereigns and their efforts to stabilize or standardize coin issue. The centralization of exchanges for bills of exchange, for shares, for banknotes, indeed the development of central banking itself. All of those things were designed to use centralization as a way of overcoming the inefficiencies and instability generating properties of decentralization. That tension continues to play out in the financial world. Well, so we have the advent of distributed ledger technology. That has increased the scope for decentralized exchange. Some of the concerns that used to arise when you wanted to know whether this note was a genuine note or not that you'd just been handed can be answered by the blockchain, fixed. When Australian notes were first issued, ladies and gentlemen, they were all numbered. And when you went into your bank and handed in an Australian note that had a number on it, the bank would go and check the ledger and find the number and then say, this is a genuine note, therefore we will pay out the gold. And then they struck the note off the ledger. That was a centralized mechanism for dealing with people who were trying to pass off notes that didn't have numbers that were recorded in the ledger. Well, decentralized ledger technology does away with that problem, right? All good. But it does away with that problem at what cost? It takes terrific energy input to drive distributed ledgers, when all the while you have a centralized system that can do almost the same thing. So where is the benefit for decentralization, particularly the use of blockchain technology? Where is the benefit that overrides the cost that is involved in that? Not to mention potential instabilities that we've already discussed, and the scope for fraud, which was raised by Ed right at the very beginning. What is the advantage? We come then specifically, as an instance of this trade-off, to think about central bank digital currencies, as they're called. We'll hear a bit about that too. Central bank digital currencies, the digital version of the notes that at least I have in my wallet. Maybe you don't have some in yours. The digital version of that. Why shouldn't central banks issue those? In fact, why shouldn't we just use the new payments platform which the Reserve Bank of Australia has already built, which already operates, that does not use anything like the energy input of any of these distributed ledgers, and yet it will deliver, as you well know, instantaneous confirmed payment from your account to somebody else. And what's more, you can program the thing. Who knew? Who knew? You can make these payments at these particular times to these particular people. You can do all that using the existing new payments technology, a platform that the bank has already built. I'm not speaking on behalf of the bank, but let me give you this view. In principle, the bank could operate all of the payment system and just issue you all with an account. Problem solved. Done. Right? Why wouldn't the bank do that? Well, this board member would be saying, if it ever came up, we don't want to nationalise the system. We don't want to nationalise it because that will once again raise concerns about inefficiency versus stability. But that tension will play out. So there they are, friends. Innovation versus regulation. Efficiency versus stability. Centralisation versus decentralisation. Let's now listen to how my colleagues deal with those trade-offs as they open with their remarks. Thank you.
It's quite the journey from corn in ziggurats to blockchain technology. Fascinating. Thank you, Professor Harper. We'll now continue with our first speaker, Mr. Alan Oster, the former Chief Economist at NAB. Welcome.
Thank you very much. Ian's always a difficult person to follow. So my quick version of who am I is basically I have one job all my life, forecasting and modelling. I did it for the Australian Treasury, I did it for the OECD, for the last 34 years I've done it for NAB. So a couple of, and I've only got 6 minutes, so I'm going to be very big picture. And I should also say I'm now retired, so I'm talking about me. When I look back, I actually look at what things have not changed and what things have changed. So I would say to you, you've got to have your macro models based, which are basically just what happened in the past. But what I think is really important is the importance of basically psychology and the consumer and business. Because if you get scared, let's say Trump scares the hell out of you, in Australia, we aren't really exposed to that unless, it affects our trading partners or it affects a consumer or a business who suddenly escalates that big time. So what I'd say to you, be very careful if it's just model driven, and also say if it's anything beyond 3 or 4 years, it's not worth having. You can do sort of, are these sustainable? What's changed, in my point of view, the big difference for me in the last 5 to 7 years is data. And banks now look at their own data. And the systems that we build are almost essentially real time. So in my previous job, I used to write a note every Wednesday saying any electronic transaction went across any of our customers, we could see it as of last Saturday. Okay, so let me give you a simple illustration of what that might do. So Federal Treasury running forecasting modelling 6 months before I knew we had a recession in 91. Alternative, COVID, second week of February 2020. We look at, we can do this data, by the way, by postcode. We look at that and we see a 45% fall in restaurants, Chinese restaurant takings in Box Hill. And for those who aren't basically looking around, that's like Chinese. And also one of the things that comes out of that is we can see where people are getting their data from, where they are in the income distribution, and where they're basically getting their money. So one thing that the government was always very interested in was that we could basically on the Wednesday tell you the number of NAB customers who were being paid the dole. So you could watch that and you could get a really close idea of what is actually happening out there. We can also look at things like, and I think this is public, basically you can essentially look at the NAB customer base and you can see, for example, and I'm sure this is true of all the big banks, that 70% of the bank's mortgage book is owned by the top 20% of the income distribution. So one of the stories about why haven't banks had a hell of a lot more problems with bad debts is they're the people that basically the regulators have essentially meant, I won't say they can't fall over, they will, some will, but it won't have the impact that you would normally expect it to have. And it also says where else where you're not being regulated as much are basically people getting the money from. Non-banks. And you see very big differences in the non-banks versus the banks. Bad debts in places like Victoria. So I sort of look at this and I'm just saying what the banks can now do is they can look almost real time. Now, I would say to you, you can't use it real time. Things like Chinese New Year change physically. Also, holidays are different. But if you look at it over a month, you can get a reasonably good deal. And that is given to the government, it's given to the Reserve Bank. And, you know, now we're soon going to have not retail sales, but consumption given out. And it's based on the bank data, basically. So what I'm sort of saying is be careful about your ability to predict anything, but also be aware that we can now essentially find out what's happening in real time. And that gives you a lot better sort of an ability to manage the system. Doesn't mean if people say sell for whatever reason, and Ian talked about a few of us, but that doesn't mean that you can actually get a good outcome, but it means at least you know it's happening. And therefore you can sort of try and avoid the problem of, you know, being the first. Well, in 1990, one of the big issues was every bank wanted to be the first bank out and leave the other three with the, and so you're not going to do that. So I'm going to stop there. I've done my time, and so thank you.
Thank you, Alan. I'm now pleased to introduce Mr. Nigel Dobson, who's lead for banking services at ANZ.
Thank you. Now, I'm going to be primarily rebutting Ian this evening. It seems unexpectedly, but I'm going to do that. And in order to do that, I've got some slides, if I can work with the tech guys. Where are they? There you go, lads. All right, could you put up a first picture? Okay, so what I tend to do when I talk about this topic is try and give an historical background. Now, you've done that amply, I should say, in terms of the last 1,000 years or so. I'm just going to focus on the last sort of 50 years, all right? And in particular, I'm going to focus on the key technological changes that changed finance for good and forever. And some of those changes were not necessarily about finance, they were about data transmission and security and efficiency. But here we go, this is the last 50 years. When I was very young, I wrote checks, physical paper. And there were a whole range of intermediaries that handled checks. Today we still handle checks, believe it or not, as you would be aware. We still process millions of them every year. But in a rapid decline, of course. And then, of course, the internet and digitisation, then the internet, frankly, changed finance forever. And I think the interesting thing, again, harking on Ian's comments, is not that the business model of banking or finance or commerce changed profoundly, but the operating model changed. And that's where we're focused, and that's where I'll talk about this evening, is how over this period of time, the operating model, the form factor of money and finance has changed, and the financial market infrastructure that supports that has changed profoundly due to significant technology changes. Now, there are three key transformation drivers you need for an operating model change. You do need a technology that offers an operating model difference, a substantial difference. You also need that operating model choice to be economically viable. So it has to be compelling in terms of its economics. And thirdly, of course, you need a regulatory adjustment that gives certainty over time. Now, that doesn't happen quickly. And every new technology, including the internet, including cloud computing, and now the tokenized economy, have led out in front, well
in advance of any regulatory adjustments. And the most challenging thing for institutions trying to adopt new technology is to try and convince the regulators how similar it is to the old technology, i.e. that the business model hasn't changed. We still pay people, we still receive money, we still lend money, and we still get it paid back. It's the way in which those transactions occur that has changed, and the enabling technology around it needs to be robustly challenged and explained over that process, eventually leading to some significant transformation in our financial services environment. And then underneath, I just want to, apart from those three key drivers that have driven us from an analog world into a potentially tokenized economy, are the Web 1, 2, and 3, which is kind of subplots within the digitisation story, with a read-only to read-write and now read-write-own. And I think that is a really, really important call-out. You read, you write, and you own your own data, all right? You are self-sovereign in terms of that. If you own a token, it's yours. You have your identity attached to that should you choose to, and it can be cryptographically verified as your token on-chain. And that is you're not relying on an institution to validate that for you. I'll get to that a bit later. So those are the tenets. You know, I have in my career been through the internet. We moved into the internet and banking, and I remember that didn't take. It took some companies a very short amount of time. It took some companies a hell of a long time to get very comfortable. I don't know how many people remember their virtual private network that they had to use. They couldn't possibly use the public internet. We're going to have the same conversations about private chains and public chains right now. Talis will probably talk about that next. And so those are the kinds of things that we're going to challenge ourselves and our regulators and our customers with over time. But in order to do that, we've got to have a compelling proposition about why. All right, so if we go to the next slide, please. And again, Ian was dead right. Over the history of the world, the way in which transactions happen or commerce happens is you have a ledger, be it clay or be it a chain, all right? And everything in between. We've always had ledgers that have recorded transactions to enable trust and verification, all right? And then you need instructions. The owner of an asset wants to sell it to somebody else in exchange for another asset or for some money, whatever form that may be. And those are the instructions, all right? Could be me writing a check, that's an instruction. Could be me moving a token, that's an instruction. But today's instructions are a smart contract, self-executing and carry programmability in tokens. The ledger, of course, has transformed into a decentralized chain, be it public or private. We do most of our work in private chain, but we've also offered customers opportunities in public chains like Ethereum, for example. A little footnote, the energy consumption now is not what it used to be. That's probably a 10-year-old problem when the Bitcoin blockchain did chew huge amounts of energy, but all of the algorithms have moved substantially on past that particular requirement and now are pretty efficient. In fact, they're very efficient. One chain I know of uses a very unique consensus algorithm. It actually uses about 1% of the energy of Visa, for example, and that's proven. Tokens, or the asset. What is the asset? It's a cow, it's a horse, it's digital money, whatever you choose. And so all of those three things have been in existence in our business model of commerce for thousands of years. Today, we're saying that the ledger is a blockchain, the instructions are a smart contract, and the asset happens to be a tokenized item. Typically a security, typically money, but it could also be artwork, property, jewelry, whatever. You can tokenize literally anything. And then you say, well, how do I trust that? That's why I go to my third slide. Again, trust was a very, very big theme of a number of, I've got to go, do I? Give me 60 seconds. Can I go to the next slide? The reason why, and to answer Ian's, what are the benefits? Why is it better? Today, we rely on institutional trust with central counterparties that enable money and assets to exchange over a period of days, all right? And I call that institutional trust, and that's a clearing and a settlement leg that are asynchronous. In a token economy, you rely solely on cryptographic trust, validation and verification through cryptography, which, by the way, is decades old, not new, but it's synchronous. One ledger, all assets live on that ledger, and you get synchronized clearing and settlement. That's the punchline for efficiency. I'll leave you there. Thank you.
You will get to hear more from Nigel in the second half of tonight. I'm sure he's got a lot more to say. I'd like to move on now to Dr. Simon O'Connor, who's the Director of the Sustainable Finance Hub at the University of Melbourne. Thank you.
All right, we're really getting into the battle of ideas here about our future. I'm very pleased to see that. So I guess I've spent the last couple of decades really trying to understand the connection between finance and economics and its intersection with sustainability and climate change. And I've come at that because I've really realised that to build a sustainable world, one where all of us as citizens can thrive and prosper and live a life of high quality of well-being, we're going to need finance to be flowing as the engine of the economy to the types of companies and assets that we need to build for that future. Increasingly, though, what's become relevant is, in fact, finance itself needs to align with that sustainable future for it to thrive and generate returns and continue to be sustainable as an industry itself. What really brought this most clearly across the world and financial markets, I guess, met a recent anniversary, a 10-year anniversary of a very famous speech by the then Governor of the Reserve Bank, of the Central Bank of England, Mark Carney, now the Prime Minister of Canada, who really brought this onto the agenda of finance, where he named it as the tragedy of the horizon. And effectively, in his description of things, and he made this speech to the insurers at the Lloyd's of London 10 years ago, where he said that the catastrophic impacts of climate change will be felt beyond the traditional horizons of most actors, imposing costs on future generations that the current generation has no direct incentive to fix. And he brought that home very squarely for the finance sector by saying that, once climate change becomes a defining issue for financial stability, it may already be too late. And so as we mark that decade-long anniversary, we have seen 10 years of action to really integrate and embed climate change risk management and sustainability into the financial services sector. Indeed, the chair of ASIC, our securities regulator here, Joe Longo, recently described this as having driven some of the biggest changes to financial reporting and disclosures in a generation in financial services. And we've seen that writ large recently, where something such as the National Climate Risk Assessment released by the government today, and traditionally financiers don't speak to climate scientists, etc., but that has sort of indicated just how different our economy is going to look later this century. The way we build infrastructure today needs to change to adapt to that. Our agricultural sectors will change, property, what we insure, how we generate energy, sectors reliant on water. How we make money in finance in the future will be very different tomorrow from how we make it today. And so we've seen this evolution where climate has been built into the financial system, infrastructure and architecture. Today in Australia, all of a sudden our CFOs are in charge of reporting on climate change risks and information and data. A new remit for a cohort who traditionally were not experts in climate change at all, but is brought forward by mandatory legislated climate change disclosures required of our largest companies. We see the largest of our institutional investors committing to net zero transitions. And yet what we know is that the Australian Stock Exchange is far from aligned with that net zero future. The ASX 300 today is probably tracking at around a 4.5 degree warming by the end of this century, well above our Paris Agreement targets of 1.5. So we're thinking of that if we're the investors of trustees of superannuation funds today, a Melbourne Uni student enrolling in his undergrad degree today will be retiring in about 2065. So for trustees not to be thinking about the shape of our economy, the shape of our environment, our climate in 2065 is fundamentally breaching their fiduciary duties to be entrusted with looking after the retirement savings of those students today. So the Sustainable Finance Hub, a new initiative and an interdisciplinary initiative within the university, aims to kind of unpack some of these constraints that still remain there to really fundamentally shift the nature of finance and the way we're applying finance to help to drive that sustainable future. A few areas of key focus here are things such as evolving the tools of finance themselves. So we know, for example, Jeremy Grantham, a very famous international global investor, who said fundamentally the tools of finance, the way we discount the future, really reflects that we put zero value in finance on our grandchildren. This fundamentally doesn't allow for the long-term perspectives, the types of incentives and focuses we need in the investments and the lending of today. We need to be thinking about discounting, about benchmarks, about how we're rating the performance of superannuation funds today that's ultimately assessed against benchmarks that, as I said before, are tracking to a 4.5 degree warming world. We know Treasury is already dealing with those, and we see from our Treasurer themselves a sustainable finance strategy in play rolling out across financial services in this country. We do need innovation in finance to ensure capital is being deployed in sectors that are under-capitalised, that are needed to help us deliver that transition and that future that we need, whether that's in investing in emerging markets, in health system adaptation, in restoring and protecting nature. By the way, the next systemic risk for us is that erosion of natural capital that we know that 50% of our GDP is highly dependent on nature and the services that it freely provides to us. System-level approaches and the portfolio management, when you consider these long-term system-wide issues, we still have portfolio managers who are chasing alpha, that is excess investment returns from a single company within a portfolio, where the externalities of that company are actually impacting beta, the ultimate economic market performance in one part of your portfolio. So we have a challenge and a contradiction within portfolio management that still exists today. And of course, finance and our ability to influence and shape what we might call more invisible sectors, where many of our biggest impacts, emissions, etc., take in place, state-owned enterprises, unlisted companies, as we see companies being privatised off our stock exchange, bought out by state sovereign owners, etc. So the future of finance, in conclusion, is entirely dependent on getting this right. And our view is that despite some of the progress in sustainable finance, there remains a tragedy of the horizon that risks undermining the financial system that is there to be entrusted by the students of today and their retirement savings for tomorrow. Thanks.
Thank you, Simon. Our next speaker is Professor Nadia Massoud, Professor of Finance at the University of Melbourne. Welcome, Nadia.
Well, hello, everyone. Thank you, Edward, for the invitation, and thank you all for coming. Let me introduce myself briefly. I'm Nadia Massoud, Professor of Finance at Melbourne Business School. My research interest fall in the intersection of corporate finance, banking, risk management, and recently I start to maneuver towards more current issue. One of the issues I investigate is social finance, which is basically understanding how investment happen in social platform, which is really fascinating, one of the topics that I would like also to share sometimes. And also start to move more into fintech, blockchain, and how to use fintech for inclusivity of finance and reaching out for remote communities. So today, my speech will be focused based on the theme of the panel. So I will be talking about the intersection. I will be talking about basically how in intersection of innovation and how we can use innovation and the ingenuity of economists in improving funding for small businesses. So let me first, before I start, because I'm targeting small businesses and medium-sized businesses, let me reflect on the current situation in Australia. So I'm going to read a little bit based on some statistics. Australia has about 2.4 million small and medium-sized enterprise, and they employ a very large proportion of the population. Around 7.4 million people work, which is around 2/3 of the national private sector workforce. And they generate a huge amount of revenue, $700 billion, which is around more than 1/3 of our annual GDP. So it is significant industry. So if we try to assess their accessibility to funding, it has been uneven. And about half of all businesses, when they access funding through especially banks, they were able only to access this, mostly to access this through the mortgage by securing their homes. So basically, when you do business, you have to mortgage your home or secure it with your home. If your business basically did not do well, at the end also you're going to lose your home and effects of your family. You can imagine this, what will have an impact, the ripple impact on the economy, and this will address Ian's point about stability. And talking actually to banks, and we have here many bankers, it is an issue that the bank realize, and they understand those small businesses, actually they're doing business by basically using their home as a collateral. So this is a big problem. And although this business is, it's a dilemma for economists when we look at it, small businesses and small companies actually generate lots of revenue. It is the source of the growth, and this is where most of the innovation happen. So if we don't help them with funding, basically we're killing innovation. And that's a big problem in our economy. And this is diagnostic part. Now, so to summarize, the key challenges for small businesses is the funding, access to funding through loan, and this is the preferable way of doing it, is you need collateral, which is your home. The second one, which is high transaction cost, if you are going to access funding without using your home as a collateral. And also there is a big issue, which is Ian also talked about, which is information asymmetry. So there is information asymmetry between the borrower and the lender. The lender worries about, because they don't have enough information, those small businesses, they don't have like lots of data, which is important information. Alan mentioned that, which is important information for evaluating the credit history of the entrepreneur or the business owner. So if you are a new business owner, it's very hard to get funding, but then how are we going to promote the economy if we don't provide the funding? So what is my role? This is basically a statistic available. You can double check this information. So what I'm bringing here results of a field experiment done by a group of researchers. I wish I'm one of them. I'm building on their research for my future research, which is related to inclusivity of finance. What they did, they looked at a global company that has a supply chain and existed in a couple of countries. And they went for the entrepreneur who works with this supply chain. And they used the footprint of their transaction as a source of data to assess their credit quality. So this is how technology connected. And then secondly, they stepped back and they thought, how are we going to help those businesses? They designed 4 borrowing contracts. The first one, which is the traditional one, which is the banks here in Australia use, where you borrow, you need the collateral, and pay interest. The second one, no collateral, where, okay, you borrow, you need to pay a small amount of your borrowing, but we're going to share your revenue. Okay? So this is profit sharing. The second one is hybrid. The third one, actually. The third one is hybrid. So what I'm going to do as a bank, I am going to lend you the amount, and we're going to agree on the approximate interest that you should pay. If you do well, we're going to share this profit. But if you do really badly, I'm going to wait for you and not squeeze you out of your business. And I'm going to wait, which is basically, if you think about it, it's kind of insurance and risk sharing and shareability of the profit in the upside. And the results from this study, what they found, this is designed, it's field, it's collaboration with industry and researcher. They found the hybrid design where there is a risk sharing and the sharing of the profit is limited to the amount of the loan, the principal, and the interest. They found it to do the best. What they found, the profit rose by 170%. Repayment rates also climbed up, and borrower demonstrated greater investment effort. In other words, it's a win-win situation. The business owner did very well, and the lender, in terms of banker, they also did well. So this basically signaling to us we need to think. So let's evaluate now the relevance of this study or the experiment to Australia. The Productivity Commission in 2021 report found a critical gap in unsecured lending for a specific layer of the business. We're talking business, not individual, from 250,000 to 5 million. And what they found that banks, this is not me, this is the commission, they said the banks remain risk averse and heavily reliant on property collateral, okay? So basically, and they didn't basically use any alternative. They wanted secured loan, and part of it we can put the blame on the regulator as well. So there wasn't any improvement in the accessibility for funding for small businesses. The situation even worse for indigenous people because the land cannot be used as a collateral because of the legal title of it. So they're already excluded from the traditional way of borrowing. So in my view, the future for finance, basically, what I suggest to the banks is to open their mind and think of other ways to help the economy and help small businesses. We need to think of new contracts to help the economy, and regulator can play a big role in that. And the future of finance will not be defined by faster algorithm, but by better contracts, once that aligned incentive and reward efforts and basically extend inclusion. In my view, the ingenuity of economists remain essential, and we cannot depend solely on AI. Thank you.
I think the problem we have, Professor Hovey, is that you have so many interesting people saying so many interesting things. Our next speaker is Professor Talis Putnich, Professor of Finance at the University of Technology, Sydney, and co-chair of the Digital Finance Cooperative Research Centre.
Thank you, and Ian certainly put out a few challenges here and a few trade-offs for us to talk about when we discuss the future of finance, and I'm going to try and illustrate some of those trade-offs with some practical examples and talk about where we see the future of finance heading. So if I want to send a picture to a friend that I have over in Paris, how do I do it? Simple, I pull out my phone, text it across, or use WhatsApp. That picture of that, whatever I send, will bounce across satellites, land on the other side of the world within a second. Bing, arrives, not a problem. Simple, efficient, low cost. But if for that same friend I want to send, say, $10 as a birthday gift, okay, to Paris, what's going to happen? It's not going to sprint across to Paris, but instead what's going to happen is it's going to run a relay race. It's going to take the scenic route. It's going to bounce around through a series of banks, clearing systems, payment systems, and if I'm lucky, it'll arrive a few days later, minus the substantial chunk that's been taken out from the fees that got clipped along the way, right? So this contrast between the convenience and efficiency that we're used to in most of our interactions in a digital world, like, for example, texting and messaging, etc., versus the way that the financial system operates, or at least some parts of the financial system operates, highlights something important. It's not just that the financial transactions are annoying, but this is actually a sign of the fact that many parts of the financial system, at their core, are still operating on infrastructure that was designed for a different era. In fact, many parts of that infrastructure haven't been upgraded since we moved, on Nigel's slide, from paper-based certificates of ownership of assets to electronic systems. That happened around the 1980s, and we're still using much of that legacy infrastructure. And it's not just payments that I'm talking about here. So think about, for example, buying or selling something else, making some other financial investment. So you're buying shares, or you're buying bonds, or maybe even you're buying a house. At the front end, you think that transaction has happened very quickly because you see, yes, brokerage account, transaction confirmed, everything good. But actually, if you look under the bonnet, what's happening is the actual exchange of ownership of the asset and the cash is going to be delayed. Maybe 2 days, maybe even more in some asset classes. And that delay isn't harmless. There's many downstream implications of that delay. So number one, you've got assets and money tied up in this system, doing nothing productive. That's the first downside. The second downside is if you delay the settlement of a financial transaction, you actually expose the two counterparties to risk. You've actually created a financial risk that doesn't need to be there. Because now I owe my counterparty an asset, they owe me cash. If the asset price changes and my counterparty disappears, I could be out of pocket. So how do we manage that cash? How do we manage that counterparty risk? Is we bring financial intermediaries in the middle to try and manage that, but that comes at a cost. It makes markets more costly, more complicated, and less accessible than they need to be. So, what if financial transactions could work as easily as sending a text message or sending a photo across the world? So imagine a world where when I buy an asset, the asset drops into my account straight away. I sell an asset, the cash drops into my account straight away. We therefore don't need an intermediary to help manage that process for us. And by taking the risk out of that transactional process, we can actually come up with a leaner, more efficient and faster version of the financial market infrastructure. Now, that is entirely possible today, and in fact, it's already happening today. What it requires is a structural shift, in particular in the way that asset ownership is recorded and transferred. That's where the structural shift starts. So we have to move away from centralized registries, and by centralized registries, you think about a spreadsheet controlled by a single entity that holds records of Bob owns 100 shares, Alice owns 300 shares, and we have to move to a distributed ledger, a network in which data packets can move across freely. Now, those data packets can represent asset ownership, in which case we call those tokenized assets. Now, when we talk about tokenized assets, the underlying technologies are blockchains, distributed ledgers, smart contracts. Smart contracts are small computer programs that sit on the blockchain and control the behavior of these data packets. Now, I want to just make very clear that what I'm talking about here is not crypto. Yeah, there is a technological overlap between cryptocurrencies, Bitcoin and speculative markets, and the tokenization of real-world assets. But what I'm talking about is modernizing the infrastructure on which assets and markets that underpin the real economy, how they function. Because that's where the big impact's going to be. That's where the world's major assets are being managed. That's where the wealth and the money sits. So modernizing that infrastructure is where the massive economic impact is going to come from. When you tokenize assets, you can reimagine the way that financial markets work. So for starters, the asset itself, being a packet of data as opposed to a record in a spreadsheet, becomes programmable, just like the packets of data that we send across the internet. So you can embed the rules of what that asset is allowed to do, where it's allowed to travel, where it's not allowed to travel. You can embed them into the asset. You can embed behaviors like automated payments into the assets to automate many functions that we do manually in markets currently. You can facilitate much more direct exchange that doesn't need the intermediaries. You can facilitate much more fluid exchange across borders because we now no longer have siloed systems, okay? And you can facilitate entirely new markets that weren't possible if you didn't have a lean markets infrastructure. And this is what we call digital finance. And this is what we're working towards the Digital Finance Cooperative Research Centre, together with industry partners, together with regulators, and together with 6 partner universities to push towards a digital finance economy. Now, what would the impact be? We estimate that for the economy, this is a productivity and an efficiency gain in the order of about $19 billion per annum. That's close to 1% of GDP, not as a one-off hit, but per annum. Now, if you think about an individual, of course, we all benefit from a more productive economy, and we're well overdue for a bit of an increase in productivity in the economy, right? But there are many personal benefits as well. So think about someone that's saving for retirement. The average person today, in today's dollars, if they started saving now, would have about $1.4 million in their superannuation balance by the time they retire. With the efficiencies that could come from digital finance, that balance we estimate would be about 1.6 million. So that's $200,000 in today's dollars that add up from all these inefficiencies through time accumulating to an individual. Now, there are many challenges along the way, of course. This isn't easy to structurally rebuild a financial system, but the key point I want to finish on is the fact that this is something that's already happening. We have the major global financial institutions, BlackRock, JP Morgan, Goldman Sachs, etc., all having launched tokenized asset products. We have central banks around the world exploring central bank digital currencies and running pilot projects, including our own central bank here in Australia in collaboration with the DFCRC. We have stable coins, which is a form of tokenized money, already circulating and facilitating real-world transactions to the tune of about $28 trillion per annum. That's more than the combined volume of Visa and MasterCard, by the way. So it's already happening at scale. The regulatory foundations are starting to be put in place by regulators here and globally, so this won't be an unregulated sector, and we're trying to accelerate this push because the faster we get there, the more of that economic gain we can actually enjoy. So if we just wrap this up by thinking back to the text message example. I sent a text message with a photo, it gets there in 1 second. In the near future, you can expect similar degree of speed and efficiency when transacting in financial assets that are in a tokenized form, not only making the financial system more efficient, but also expanding the reach of markets to asset classes where we haven't been able to apply markets and market infrastructure to date. And who knows, one day that friend of mine might text back and say, hey, actually the money arrived before the photo. Thank you.
Now we will hear from our final speaker tonight before we have what will be a very truncated break. But may I please welcome Professor Alan Fels, AO, former chair of the ACCC and professor at the University's Melbourne Law School.
Ladies and gentlemen, I just have a few general comments on regulation. And the theme, as always, is that some things are always changing. And in that case, money is always changing, always has. Coins, notes, electronic checks, electronic deposits, digital money, and so on. But the need for regulation remains, although its form must change. And in particular, the main forms of regulation that have always been needed and probably always will be are in relation to the protection of competition, in relation to the protection of consumers, and also of investors, for example, shareholders, and the need for prudential regulation, that is to make sure that financial institutions operate safely and can be relied upon. And as I've said, the forms of regulation change. Ian also mentioned the conflict sometimes between innovation and regulation, between stability and efficiency. There's also one other conflict partly implied by what he said, and that is between different elements of regulation. For example, prudential regulation can conflict with having more competition. Maybe there will be prudential requirements that get in the way of new players entering a market and being able to compete. It's another tension partly implied by Ian, actually. Now, one of the other important things is the role of trust. Now, that has been mentioned quite a lot as we have passed through tonight, but in all markets, it's important that there be trust. When you're buying a Mac burger, you want to trust that the food hasn't got, Leongatha mushrooms in it, or that sort of thing. But the need for trust is very high with regard to finance. Nearly every aspect of it is important, whether it's deposits in banks, that they're safe, that the banks or the financial institutions will honour their obligations, that information will be accurate, the funds accessible, the bank solvent and regulated, and the deposits are protected by sufficient reserves. There's also a need for trust in information and transparency. In other words, there needs to be financial disclosure of all kinds. There needs to be market participants who do fair dealing and proper enforcement of rules and ethical behaviour, and so on. But investors and citizens need information if they are to proper and true information, and transparency if the market is to work well. We also need trust in institutions and governments. We need trust in the regulatory institutions, whether it's central banks, the securities and competition regulators, prudential regulators, and also in governance of business itself, corporate governance, boards, auditors, rating agencies, and so on. And also another aspect of trust is trust in the system as a whole. We want to be confident that payments will flow smoothly, credit will be extended, markets will price risk rationally, our institutions and governments will operate properly, because without them, a financial system will not operate well. There will be bank runs and liquidity crises, poorly functioning credit markets, slower economic growth, and so on. So my point today is to emphasise that trust is important, and regulation plays a very important role in that. I believe that on the whole, regulation well done certainly helps build trust in markets. And also the other point to briefly touch on is that despite the possible positive contribution of regulation, we still rely heavily in the financial market on ethical behaviour by participants. And we witnessed in the time leading up to the Royal Commission on Banking, and in many cases since then, failures of ethical behaviour right across a very large part of the financial system. And there are a number of causes of that. I think there are some rather big cultural changes came into the financial system that occurred around about 2000. I always thought when the banks got involved with life insurance and other financial institutions that went beyond banking, that a culture got into banking that was not right for a proper banking system. So those are just a few brief comments. We'll need regulation for competition, consumer and investor protection for prudential purposes, but above all, we need trust in the system and ethical behaviour. Thank you.
Thank you, Professor Fells. It is now time for what is a very brief break. I apologise. It'll be a few minutes. So please feel free to move about and stretch your legs. We will then move into 2 panels on new technologies and regulatory approaches. Thank you. For those of you who have made it back from a very brief tea and coffee, welcome back. So our first panel this evening, we're going to explore how some of those emerging technologies are reshaping the financial landscape. We have heard bits and pieces, and I feel like there's a lot more we can learn from our speakers tonight. So from the promise of these innovations, their unprecedented efficiency, but also the new vulnerabilities they bring with them. Now, I am going to try and be very fair and even-handed and start with the people I cut off. So, Nigel, I will start with you. Can we start with the positives? How are these technologies making finance faster, but also making finance more transparent and more efficient?
Right. Is this working? Yeah, it is. Well, I think between Talis and I tag teaming just now, I think we laid the case for the financial market efficiency, particularly in wholesale markets. I mean, I think in retail markets like the picture versus the remittance is something which is emerging, but the real gold is in what we call atomic settlement, where two assets exchange simultaneously to crystallize an immediate transaction, which, as Talis explained, may have and often still does take days, and relies on different infrastructures to interact, infrastructures that were not built for a whole transaction, but part of a transaction. And so that's where I think the efficiency is most profound. So what's the second part of the question?
Transparency.
Transparency, sorry. For anybody who's had on-chain experiences, you will know that pretty much everything is visible. Now, that actually becomes a problem for a lot of people in terms of privacy. So you can pretty much research any public chain transaction through an Explorer-type interaction, and you can not see all the details, but it's all hashed or coded. But pretty much every transaction is on a public record on a public chain, but without necessarily revealing all of its critical data. We have done a number of experiments with private chains and public chains, ensuring that privacy is maintained for asset transactions, which is what is obviously a minimum standard for professional investors. And really, I think that's probably where I wouldn't call it a vulnerability, but I do think it's something that needs to be shaken out as to what type of market participants want what type of privacy, and and if that is reflected appropriately in the prevailing regulations of that jurisdiction or jurisdictions. So I think that's probably the key element of risk at the moment. And then there's of course the identity of the individuals who own the assets in the wallets. But that's not really any different than those who own bank accounts or own assets today on registers. It's a quite an equivalent problem, one that does require due diligence in a traditional way. But once that identity, or even the identity of the token identity versus the owner of the token identity, which are two different things, once they're established, they can be cryptographically locked and transparently tracked across the life cycle. Now, again, we're not talking about crypto here. We're talking about regulated asset markets, which start with security, identity, KYC in mind by design.
Great. And Talis, I'd love you to expand on that, particularly where you finished in your speech about the immediacy that those financial transactions could beat a photo or a text message around the world. So surely that's a positive, both for the finance sector as well as consumers.
It is indeed, and
yep,
yeah, it is indeed, and it's not just about getting some money faster. It's not just about getting an asset faster. What actually the speeding up of the settlement of transactions does is removes a key financial risk from the system that doesn't need to be there. Is that counterparty exposure. From the time we engage in a transaction to the time we settle it, we are exposed to one another. And that's where we have these layers of financial market infrastructure, clearing houses, centralized counterparties that take on that risk on behalf of others. That infrastructure is there as a band-aid to patch over this problem, this risk that we created in the first place by separating the trade and the settlement processes. if you combine them using what Nigel referred to as atomic settlement, where the trade is the settlement, then that whole layer of market infrastructure goes away. And when you take that market infrastructure away, the markets actually become simpler. It's easy to look at this and say that cryptographic and tokens and distributed ledgers, that's more complicated. But actually, if you write down the architecture and do a diagram of what does the market look like, you've taken pieces out of that diagram. So what that does is also potentially allows for sort of a simplification of the regulatory frameworks, because you don't have these concentrated sources of systemic risk sitting in there. That could be the next point of failure for the entire market. It also makes that lightweight market infrastructure able to be applied in places where currently we haven't built markets. So it expands the reach of one of our most powerful mechanisms in the economy, which is markets. Markets for driving capital, markets for making investments, markets for providing price signals. So where are those new markets going to pop up from this lightweight infrastructure? Well, one of the things that ASIC has been writing about is we have ballooning private markets in Australia. So companies are increasingly choosing not to list on public stock markets and staying private. We have private credit and debt markets that are emerging that have far less transparency than the lending that's happening through banks. And so these private markets are one of the areas where a lightweight market infrastructure could help bring both transparency and liquidity into those asset classes and address some of the issues that ASIC are talking about. It's also an area where you could expand this reach of market mechanisms into some of the things that you're talking about sustainable finance investment products and new impact investment products, drive more capital into those areas through market mechanisms. And we know our Prime Minister just came back, or was just negotiating deals in the US about critical minerals, which we know are an increasingly important asset class. We are major players globally in the critical mineral space, but we don't have markets for those key assets. And so this is like another example where the reach of markets, because of a lightweight infrastructure, could actually make substantial changes to the economy, not just make the financial system itself more efficient.
I might ask Simon to come back on that in our next panel. I will come back to other markets, but I do just want to come to you, Alan, about the positives of those emerging technologies before we move on to those risk exposures.
Okay, I'm not an expert in all these various new systems. If you can get an exchange of value, that's really important. And the more efficiently you can do it, the better. The one issue I would go back and say that history tells you, if you get a failure in that exchange, the impact on the economy, you basically get a U, down, flat, and takes you a bloody long time to get back. No more of these Vs. And so that is the really important point. And, you know, if you want a good example, when I came back from Paris at the OECD, back into Treasury, I was given the job to write what the hell went wrong in the recession. Okay? Obviously, it was monetary policy, people beyond that, but the real issue was, why did Victoria and South Australia have terrible recessions? New South Wales and the others had hardly any. And the answer was financial institutions fell over. Pyramid, you know, state banks, etc. So all I'm saying is, yes, it's really good, but if it falls over, all the benefits you talk about are going to get wiped out really quickly. So that's that's the trade-off.
Can I respond to that?
Yes, absolutely. Ian's
How many
responding in
financial
the front
crises
row.
have been caused by financial market infrastructure versus financial market behaviour and lack of regulation?
Well, you know the answer to that one is basically the.
Yeah. So that's the point that Talis and I are making. We're not standing up saying that this is a new way of doing business. The business model is the business model. The operating model is what's changing, and I just want people to focus on that. You know, we're saying we wouldn't consider going back to paper documents today, would we? Would we? At all? Wet signatures, anybody? No. And so, you know, we're saying this is an advance in the financial market infrastructure, which facilitates an operating model which is demonstrably more efficient and should be regulated. Absolutely.
Nadia.
Yes. Let me comment on this. Actually, if you look at the history where the failure of 2008 was the failure of regulation. And the crypto market existed because of this failure. So addressing the shortcoming of our traditional system. I'm not saying replacing the current system, but we have problem with regulation. If we don't understand how to fix the regulation problem, our problem regulation is hindering innovation. And there is lots of benefit of the blockchain just actually locked out because of the regulation, especially in Australia. I teach the course when I look at, for example, the funding they're providing for innovation, it's huge. But then when you want to have innovation yourself, and I'm one of them, actually I have my innovation, and I couldn't move forward, not because the market is not ready, because the regulation did not allow me to do specific things. And that's the big problem for us. And to comment also on Tala's point, where the infrastructure change, yes. Additionally, we will create opportunities for other products to be traded on those platforms. That basically now we cannot trade it. It's locked in with specific institutional investor, and retail cannot access it, and the institutional investor will be just locked in it until it basically at the end term of the investment. So we can create more liquid market for many more assets.
Yes, Talis.
I couldn't stop myself from also commenting on this issue of crises, because it is important. Like, where's the next crisis going to come from? If we think about what happened in the GFC, global financial crisis, and what we did subsequently, I mean, what we had going into the GFC was a tangled web of counterparty exposures, in many cases with a lack of transparency over exactly where those exposures sat. And once it started to unravel, man, did it unravel, right? And so what do we do post-GFC? We mandated in many cases to push some of those bilateral counterparty exposures into clearinghouses and say, they're good at managing risk, they can do it on behalf of us. And they will then make it a bit safer that if one party goes under, these clearinghouses will be well capitalized, etc. So we didn't solve the actual counterparty risk problem. We just shoved it from one place where we didn't have much visibility over it into another place where it could be managed a bit better. And there is now a next step, which is you don't necessarily need to create the counterparty risk in the first place. If you can solve the operational challenges of synchronizing siloed registries and make sure that the exchange happens at the time of the transaction, you avoid a lot of the counterparty. You can't get rid of entirely out of counterparty risk in the financial system, but you can take substantial chunks of it away. And that's what we're moving towards.
Just before we move on to some of the risk exposures and things, I do just want to throw a quote at you that actually came from another Melbourne Connect event, which was AI and finance. And one of the panelists from Algorand said, the problem we have in finance at the moment is we're just digitising old mistakes. The system itself isn't changing. So in terms of new technology and what it brings to finance and banking, is there a danger that we are just digitising, that's the word she used, pre-existing systems and making the same mistakes over again? Alan?
Why did I know you were going to ask me that? All right, so I'll be honest, I'm a skeptic about AI. I'm a skeptic in the sense that I have no doubt it's going to be really good at innovation in terms of how a bank will do things. And I've told a few people, in our bank anyway, what they did is they're using AI to basically write ads, and then they look at what marketing department did and what the AI did, and most customers prefer the AI. Where I'm a skeptic is more that I don't think it's going to create as much trouble in terms of unemployment as what most people think. And the reason I say that is there'll be lots of people and jobs that will no longer exist and never exist, and they'll be in trouble. But there'll also be new jobs that don't even exist now. And so I would look at that and say, if I can use a bit of old-fashioned economic history, Industrial Reserve Army, Marx, his argument was essentially you'd get communism because the entrepreneurs would be so good that what they would do is generate so many people being unemployed that those people being unemployed would take over the system. And that's never worked in terms of that, and I see that a little bit like AI. And I also worry in my own own area, the assumption is that consumers are rational and don't do stupid things. And I don't think that's going to work.
Nigel, you reached for your microphone then.
I can't help myself. The other part of the presentation that I didn't show you today was about the convergence of on-chain finance with agentic finance, right? And agents, financial agents, shouldn't be confused with financial market infrastructure, firstly, right? They are effectively replacements for, unfortunately, for economists, potentially, portfolio managers, all manner of financial industry jobs just to stay with that sector, possibly my own in the future. But the fact is they can interact with, logically, contemporary operating systems like on-chain finance because they are able to have, you can facilitate machine-machine interactions best through tokenized markets than any other available technology. So for us, it's a logical convergence of agents acting on behalf of individuals and companies and portfolio managers to make that process of securities buying and selling more efficient. But still, I'm sort of in Alan's camp as well, though. Much yet to be proven, but I would say that the go-to tech for transaction resolution would almost inevitably be on-chain finance for agents.
I'm going to give Nadia the last word.
Sure, yes. Actually, this is related to what I'm trying to bring, your question, which is basically banks are traditional in Australia. They are like stuck to their own way of doing stuff. I'm sorry for the bankers. And they wanted just basically making profit. If you look at the banks in Australia, they don't make top 40 in the world. But if you look at their profitability, they make top 1 to 3rd. So they are basically focusing on just making money and not focusing on how we can improve. Doing digitization, just digitization, they're not thinking, like they are going for hanging fruit, low-hanging fruit, rather than innovation and making like foster growth and foster the growth of business. Yes.
Thank you, Nadia. Now, Nigel, on your behalf, I'm keeping an eye on your time because you've got another event to host. So please thank Alan, Nadia, Nigel and Talis. Thank you very much. And I'll invite the second panel up. Thank you. So we've got Alan, Ian, and Simon. You're far away down there. You able to get through? You all right? So our second panel this evening, we're on regulatory control and stability. And I think it's something all of you touched on, and I think Alan in particular, you talked about trust and the importance of that trust. So how can regulators work toward mitigating some of those short, sharp shocks that we've seen, like tariffs? You need the microphone. I'm awfully sorry.
Well, I was just going to comment on the short, sharp shocks of tariffs. First of all, I'm dead against the tariffs and so on. People said that that would create a shock effect on the stock market. It hasn't had any effect whatsoever. The stock market just is not reacted negatively. That's true. But it's quite interesting. I think it was once business knew what the new rules were, they adapted to them. I think, Ian, that also is a really important point. In fact, let me throw it to you on the bond market, because I think that's where the bigger change from Trump might be. It's starting to occur, isn't it? Yeah. In fact,
Ian,
We ask him what's going to happen to bond markets.
Oh, thanks for that.
you don't
Well,
need
I'm
me.
just making the point that in response to this particular issue, right, the bond market is very focused on what this might mean for public sector finances, right, particularly for the state of the US deficit and US borrowing, right? Not just tariffs, that's part of the story, but the whole scene. And the bond market, the US, let me just back up and say, people often ask, you know, how do we stand in relation to what's happening in the US? As you know, we're not a big customer. The US, they're not a big customer of ours. The Chinese are doing a great job at insulating themselves from what's happening in the US. If the Chinese are insulated, we're insulated. So it's not the real markets that'll affect us. If we get affected, it'll be through the financial markets. And it'll be through the bond markets in particular, right? So US bond rates undergird, US government bond rates, undergird bond rates in all of the markets, including ours. Now, if that goes for a row, it's sort of shown some and then it's gone back again, that's the one you watch. And that all has to do with one's trust in the capacity of the US government to actually deal with this. There's a nice side link here to stablecoins. Because some have suggested, right, that stable coins could be used as a device for what economists call financial repression. In other words, suddenly a way of demanding or getting a demand source for a whole bunch of government bonds that certain administrations trying to sell. Very helpful. Stuff them into stable coins, issue the stable coins. People think these are all safe because they're US government securities, right? US government bonds. Now watch the bond prices fall and see what happens to your stable coins.
Simon, you're nodding in the background there.
I don't have too much to offer about our stable coins and bond markets, but I mean, I guess where this comes down to me is maybe your first question is the regulator's role here is to help to mitigate the shocks and to help with financial stability, economic stability. And I think that's why we're seeing regulators grappling with this in so many ways. And I guess climate change is one of the newer remits of the regulators and of APRA and the Council of Financial Regulators in terms of doing that. And so there are measures they have at hand to test the vulnerability of our financial system. So you've had APRA requiring insurers and bankers to undertake climate vulnerability assessments again across their portfolios. And we're starting to get initial results of that. And often, surprise, surprise, a bank will tell you, well, our risk is so dispersed across our multiple mortgages held across multiple geographies that our climate risk is also so dispersed that we are not ultimately vulnerable. The problem is when you overlay that with the climate science, who tells you that we can't look at climate science from a linear, gradual kind of pathway, that in fact some of the risks, as we heard recently in our climate risk assessment, that risks can compound, they can cascade, they can be chronic, they can breach thresholds, and all of a sudden you have these fat tail impacts, which is always, I guess, in a sense, the role of the regulator to find where those might, I guess, start intersecting and increase the vulnerability and instability of our financial markets. But it's fascinating, I guess, to see the global regulators grappling with this new whole area of risk and building it into existing financial regulatory tools and measures that they have at their availability.
You've moved on to those long-term risks very seamlessly. Alan, you were going to come in there.
Well, on the long term, I was just going to ask, how good are the financial markets in Australia and Europe and elsewhere to be adequate for dealing with change, with innovation, with new innovation? I mean, in the US, where there's been huge innovation, it seems to me it's been helped by having very good financial markets which can invest heavily in innovation. And one of the many causes of Europe's slowness, it seems, is it hasn't got great financial markets. And perhaps the same here. I went to some meeting the other day where everyone was complaining that Australians aren't risk takers and not taking enough risks. But I wondered if part of the problem was maybe they didn't have access to fairly risk-taking financial markets that would enable them to move. And in that regard, I was just thinking about some of the newer areas like climate change. We've already established the Clean Energy Finance Corporation because the normal market won't take care of things. We've set up another one, the National Reconstruction Fund, which is about boosting Australian made products and all that. So how good are the financial markets in a fast-changing world?
I think that's a very good question, Alan, and I, Imogen, if I may, wanted to come back to this point about efficiency versus stability. Both Talis and Nigel make a very valid point that many of the changes that we're contemplating and that they've spoken about eloquently and in detail will enhance the efficiency of the operation of financial markets, and that will save us money, it will improve productivity, there's no doubt about that, right? But neither of them spoke at all, is this working?
Yep.
Neither of them spoke at all about the stability risks. Alan Oster made exactly the right point. For every efficiency gain that you might get through operating markets more efficiently, and that's the operating systems they're talking about, and they're good to have if you can get them. Let me not say that that's a bad thing, but let's not forget that the costs of instability, and instability often arises in financial markets and is compounded by financial markets and banking systems, leaves those gains in the shade, right? The GFC cost Australia 6% of GDP. So much for these small gains you're trying. They're good gains if you can get them, but if you ignore stability risks, whoomph, you've lost the lot. Right? And this speed they talk about is also something that is presented to us as an unmitigated benefit. Again, folks, I'm talking from my own perspective. I'm not giving you an official position here, right? But this speed that is touted is spoken of as if it were an unmitigated benefit. That very speed can be the source of the instability that you're talking about. That very speed. So at the moment, the way the law is written is that if a bank is in trouble because the depositors are fleeing, and the depositors might be fleeing for no rational reason except that there's a rumour that's spreading, right? And they go. Now, Talis's system will see all of that settled. Bang, 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 gone, right? And by the time the bank turns up at the central bank's door and says, we have a liquidity crisis, the central bank says, no, you don't. You have a solvency crisis. You're already insolvent. And there's nothing we can do for you. Nothing, right? So we deliberately put into the system, as it currently stands, what they're calling inefficiencies, and yes, they are inefficiencies, but it's like putting sand in the gears, deliberately to slow the process up. In the old days, the bank used to close its doors. That's what happened here in 1990. They just closed the doors and said, sorry, folks, right? We're closed. And that gave enough time for the system to resolve itself, and we eventually got through. In Talis's and Nigel's world, there's no closing doors, folks. It's gone, right? What's gone? Well, the payment's gone. And similarly, yes, with the deepest of respect to Talis, sending a photograph to somebody else, right, at the other side of the world, well, that person isn't concerned whether the photograph has been interfered with by AI on the way through. Whether, in fact, it is the jacket that I was wearing when the photograph was taken. Well, I mean, who cares about that? We're talking about financial claims here. We're talking about the probity and security of financial claims, not somebody's image or photograph. And the reason why these things are deliberately slowed down, forced to go through a whole lot of regulatory layers, is because if at the end of the day when you get that payment and you say, hang on a second here, this isn't a picture of me, this is my sister, right? Or, hang on a second here, I thought I was getting $10, I've got $9.55. What happened to the 45 cents, right? And when you begin to suspect that something's gone on and you've been taken down, that's when you get on the phone and tell your mates. And they do the same thing. And then they do the same thing. And before you know where you have, you've got a crisis on your hands. Ladies and gentlemen, I have lived through this. I was on the board when we went through the pandemic. And the banks did exactly what you'd expect. You and others took money out of the banks, fearful of what the pandemic might do, perfectly reasonably. And behind the scenes, the central bank bought the securities the banks had to sell and supplied the liquidity, which then funded your requests. So you were happy, you took your cash home, you put it under the bed, and you thought, okay, it's okay, and you stopped panicking. That's great. As a result of that, the Reserve Bank of Australia is still in negative equity. It is still technically insolvent, right? I mean, obviously it isn't as part of the entire Commonwealth, but it's technically insolvent. We spent public money, large amounts of public money, to secure the integrity of the Australian financial system, and I stand here today to tell you that I would do exactly the same thing if I was called upon to do it again. Fast finance and fast settlement exacerbates that problem, right? And there will therefore be a need not to turn our backs on it. As Talis rightly points out, these things are already happening. Yeah, right. But what it calls for is some very severe thinking on the part of regulators as to how we manage the public interest through this process. Talis is here. He runs a centre, which, as he pointed out, the Reserve Bank of Australia is part of. So we're close to him and his colleagues, trying to work out and contribute to this discussion how the central bank can respond appropriately. So neither do I want you to get the impression that the bank, or Harper in particular, has his head in the sand and is just trying to ignore all of this, right? No, we're not. What Harper's doing is simply reminding you that it is not an unmitigated benefit.
Okay, Professor Harper, I think if Shakespeare wrote a play about finance, you just starred in it.
Lothario.
You would. I'm hesitant to do this. I'm keeping very much an eye on time. Simon Allen, would you like to respond?
Oh dear.
I know.
Let me just maybe, a voice and a perspective we haven't heard tonight is that of youth, which is not me. But what I did before coming tonight was I did ask my 16-year-old daughter, you know, what's the future of finance for you? She's got a new job, she's got her first super, she's got a tax file number, and she basically said to me, it's my money, I want to access it when I can immediately. I want the banks to get out of my way and let me spend it. I also want to be able to see through to, if I'm putting my money in the bank, I want to know where they're lending it, and I don't want them doing anything nasty with it. And I think this is sort of a bit of a probably useful kind of, we're moving into a period of hyper-transparency where there is data everywhere, where we have the full portfolio holdings disclosed now of every super fund, where a kid of 16 will be able to know exactly where that money is going when she puts in a bank or a super fund. And this is what I would call the ultimate democratisation of capital. And I think this will start shifting and shaping markets and probably push from the demand side that emphasis on speed and haste as well. So there is a tension to manage here for the consumers, which we are all obliged to be serving as an essential service of what finance does. It's not about us, it's about them. So maybe that's my final comment.
And I think that's brilliant. Looking forward is a great place to finish. So I would love to thank our speakers for tonight for sharing their expertise, and to everyone who joined us in the room and facing that Melbourne weather and online. As we've heard tonight, the future of finance affects us all, and conversations like these at Melbourne Connect with the University of Melbourne are crucial for building a more resilient and inclusive financial system. So thank you all very much for joining us tonight.